Imagine discovering a banking system larger than many national economies, a system moving trillions of dollars every day. Yet most people have never heard its name. It has no neighborhood branches, no ATMs, no savings accounts, no familiar logos. And yet, it quietly finances governments, corporations, investment funds, global trade, even traditional banks. Most people believe money flows through banks. Architects know banks are only one layer of a much larger financial architecture. Beneath the visible system, another network emerged, built for speed, liquidity, efficiency, and institutional scale. Economists call it shadow banking. The name sounds mysterious, even dangerous, but the reality is more sophisticated. Shadow banking is not necessarily illegal, nor is it inherently unstable. It is simply banking performed outside the traditional banking framework. And once you understand why it exists, you begin seeing the modern financial system as it truly is. Today, we decode the hidden banking architecture where much of the world's capital actually moves. Traditional banks perform an essential role. They collect deposits, they make loans, they facilitate payments. For centuries, that architecture supported economic growth. But as the global economy expanded, capital markets became increasingly complex. Multinational corporations required enormous financing. Institutional investors managed unprecedented amounts of capital. Financial transactions accelerated. Banks alone could no longer satisfy every need. Markets demanded flexibility, speed, specialization. New financial institutions emerged: money market funds, structured investment vehicles, finance companies, securitization markets, repo markets. Each solved a specific coordination problem. Individually, they appeared unrelated. Collectively, they formed a parallel financial system, not replacing banks, expanding beyond them. Every financial system depends upon liquidity. Liquidity is often misunderstood. It is not simply money. It is the ability to move money efficiently. Imagine a global corporation needing billions of dollars overnight, or an investment fund temporarily holding excess cash. Traditional banking may be too slow, too expensive, or simply unnecessary. This is where shadow banking excels. Capital flows through short-term funding markets. Assets become collateral. Collateral supports borrowing. Borrowing finances investment. Investment generates economic activity. The system continuously recycles liquidity, sometimes within hours, sometimes within minutes. To the outside observer, the process appears invisible. Yet beneath global finance, this machinery operates almost continuously, quietly coordinating enormous amounts of capital.
The strength of shadow banking is efficiency. Its weakness is confidence. Because much of the system depends upon short-term funding, participants must continually trust one another. Collateral must retain value. Liquidity must remain available. If confidence weakens, the architecture changes rapidly. Lenders become cautious. Borrowers struggle to refinance. Liquidity begins disappearing. Notice something important. The buildings remain, the computers remain, the financial contracts remain, yet the system slows dramatically because finance ultimately depends upon belief. The global financial crisis demonstrated this principle. Many institutions remained operational, but confidence evaporated, funding markets froze, liquidity vanished. The crisis spread not because money disappeared, but because trust did. If shadow banking creates risks, why does it continue expanding? Because systems survive by solving problems. The modern economy requires extraordinary amounts of capital. Pension funds, insurance companies, asset managers, governments, corporations. Each manages different objectives. Each requires different financial tools. Shadow banking provides specialization, lower costs, greater flexibility, faster capital allocation. The architecture evolves because incentives reward efficiency. As long as participants perceive the benefits outweighing the risks, the system continues growing. History repeatedly demonstrates this pattern. Innovation creates opportunity. Opportunity attracts capital. Capital increases complexity. Complexity eventually creates new vulnerabilities. Every financial architecture contains this trade-off. Efficiency and resilience rarely maximize simultaneously.
Most people imagine banks sitting at the center of finance. Architects see something larger. Banks are participants, not the entire system. The deeper architecture consists of capital flows, collateral networks, settlement infrastructure, liquidity providers, institutional coordination. Banks operate inside that architecture, alongside investment funds, broker-dealers, clearing institutions, money markets. The financial system resembles a living network. Every participant performs a specialized role. No single institution controls everything, yet together, they coordinate extraordinary amounts of economic activity. The lesson is profound. The most important infrastructure often exists beyond public attention. Invisible systems quietly sustain visible prosperity. The phrase shadow banking encourages the wrong mental image. It suggests secrecy. The deeper reality is architecture. Modern finance evolved beyond traditional banking because the economy evolved beyond traditional banking. Complex economies require complex coordination. Most people study banks. The architect studies liquidity. Most people study institutions. The architect studies connections. Most people study crises. The architect studies the incentives that make crises possible, because every financial system ultimately depends upon the same invisible foundation: confidence. Without confidence, liquidity disappears. Without liquidity, credit contracts. Without credit, economic activity slows. The buildings remain, the regulations remain, the institutions remain, yet the architecture changes. The greatest opportunities in finance rarely exist where attention is concentrated. They often emerge one layer deeper, where capital is coordinated rather than merely stored. Most people study money. The architect studies movement. Because wealth is not created where capital rests, it is created where capital flows. This is Nexera, decoding systems, architecting wealth.